everyone, and thank you for joining us for our second webinar as part of Asset Management Awareness Month. We're really glad you were able to attend today and hope that you will enjoy the presentation that we have planned for this week. Before we get into the presentation, I have just a quick note to go through to make sure that this all runs smoothly. We will be recording this session and posting it on NPMA's YouTube channel. So just keep that in mind as you're asking questions at the end of the presentation, that they will be recorded. So with that, we do have two options for you to ask questions at the end of the presentation today. We are going to save them for the end because we do have a lot of content to get through. The first option is to ask a question out loud. If you would like to ask a question out loud, you'll notice in your GoToWebinar panel on your screen that next to your name, there's a hand icon. If you press that hand, you're basically raising your hand and letting me know that you have a question. And since everyone is in a mute mode, you'll need to do that to be able to ask a question. So I will unmute you when we get to our questions part of the presentation if your hand is raised. Do note that the hand is a little bit sensitive, so just make sure that you don't have it checked. It looks like everybody's hands are down right now, so everyone on the phone is in good shape, but it is easy to accidentally press that hand, and then I'll be unmuting you a little bit later. The second option, if you would prefer to ask your question anonymously, that is also acceptable. There is a questions panel on your screen in the GoToWebinar panel where you can type in a question. If you type in a question, then I will ask Bill, our presenter, the question for you a little bit later, but I will not announce your name, so that will not be part of the recording. So that is the other way of asking questions and probably the most popular way of asking questions. So feel free to type those in at any time, but we will save them for the end. Another quick note, if you are planning on asking a question out loud and you are not using your computer mic and speakers, if you have called in with the telephone, you must enter the audio pin for me to be able to unmute you. So if you are in now and you don't have your audio pin entered, just click on the audio section of your dashboard and you'll notice that you have a personal pin that you can enter, and that will give me the ability to unmute you at a later time. If you're using your computer mic and speakers, then you're good. No action is needed there. My last announcement is NPMA is awarding everyone who is participating today that is an NPMA member with 1 CEU credit. All credits for Asset Management Awareness Month will be awarded at the end of the month. But if you have a group of people with you in the room, so if you have a conference room and not everyone is logged in with their name, if you could either chat their names over to me or shoot me an email after the presentation and let me know who all was in the room with you, I'll make sure that we're able to provide credit to everyone who's participated today. So I believe that covers my announcement. So I am now going to turn the presentation over to our presenter today, Bill Love. Bill, it's all yours.
Okay, well, thank you very much, Jessica and NPMA, for inviting me to present this webinar as we celebrate Asset Management Awareness Month. So welcome, everyone, and thank you for joining today's presentation, where we're going to talk on a high level about managing capital or corporate assets, a subject I've been deeply involved in for many years. So my hope today is, and my goal is, that you will gain a few nuggets and a deeper understanding of this topic, and that it will help you perform in your jobs at an even higher level. So I'll try to keep it educational and entertaining, and I like to use lots of graphics and animation, and I'll try to leave some time at the end of this hour for your questions and discussion. So another thing is temporarily, if we go off into a particular area of discussion that is different than the work that you do, please hang in there with us as we tie it all together at the end. So I recognize there are lots of different disciplines listening in today. So this presentation represents excerpts from many other presentations that I've given over the years, and some of you may recognize portions of this content from previous talks at one of our local or regional or national seminars, or maybe you've seen some of this information in the Property Professional magazine. So Much of what you see in here today can also be found in my latest book, which I've creatively titled Capital Asset Management. So let's get started. We have a lot of ground to cover today. Okay, as you'll see here today, capital asset management touches on virtually every topic you can imagine. Let's take a look at some of these. All right, computer history, shrimping, law, cattle ranching, prehistoric hunting, wonder what that could be about, language, economics, finance, business, and a favorite of most of us, pizza. So, as I said, capital asset management touches virtually everything. So our audience today consists of a broad cross-section of experts. I know that you are all, some of you are experienced in operations, some in accounting and finance, some in material handling or contract and program management, and many more disciplines, I'm sure. So hopefully, like I said, you can draw some goodies out of this today to help you in your daily work. I'd like to begin with a few questions. Why do we call these things capital assets, and from where did that term originate? There's a little bit of history involved here. I found it rather interesting, and when I was first involved in this business of capital management, and I thought we could set the stage here for today's presentation by giving you some history. So this hopefully will help put things in context for you. So we're going to get into some interesting things here in just a second. All right, so who said Latin was a dead language? So finally, after 50 years, literally, I get to draw upon those 4 years of high school Latin classes that I took. And I know that occasionally I get to use that. So here is a herd of cattle. All right. I know some of you watch those old cowboy western shows, you know, the kind where they had great herds of cattle and they had these roundups and they drove them across the plains to be loaded onto railroad cars, hard to say, where they'd be taken to markets, you know, back east. There was a favorite show many years ago called Rawhide that comes to mind. Some of you may have watched it. All right, enough of the TV trivia. So let's move on here. For centuries, the measure of a person's wealth or a family's wealth was how many head of cattle did they own, or how many sheep, or how many goats, or how many pigs. So obviously a rancher with 400 head of cattle was theoretically 10 times richer than someone who only had 40 head of cattle. And that, of course, assuming that the health of the animals was equal. So for more than at least 500 years, this type of live capital has been used as a means of wealth measurement and as a type of currency before our modern day concept of cash became so all-pervasive. So let's take a look at some closely related terminology here that goes with capital. We're all familiar with capital stock. Well, the word stock comes from an Old English word, and it has to do with trees and how they grow and the deep roots and how they grow over time. So since actually the Middle Ages, these terms have been used for basic commerce and business. So in France, for example, heads of cattle were used in place of cash, as we know today. So an asset in economic theory is something that produces an output, but it's only partially consumed. So as you can see, as we complete our vocabulary lesson here, these things all tie together: capital, stock, and asset. And I want to make a point that capital stock in this context today is not the fact that you might own 50 shares of AT&T or 100 shares of Apple or whatever. This is hard goods stuff, and we'll get into more of that here in a bit. So a printing press, for example, is a good example. It's a capital item that produces something that may only last a few days or a few weeks, like a newspaper, for example. So this hopefully gives you a little bit of background with some of this terminology. So let's now fast forward to the current day, and let's look at a classic definition of capital assets that many of you, I'm sure, are very familiar with. These are long-term items that are not bought and sold in the ordinary course of business. And this is the ASTM, the American Society for Testing and Materials, now called ASTM International, that defines capital assets. There are a couple related terms in here. You'll see I've highlighted long-term and fixed. And we're going to look a little more at these terms shortly. So as you can see on a global scale, there seems to be a general consensus as to what defines a capital or a fixed asset. So, all right, let's get more specific now with another example that I've gotten into more detail here. First, let's talk about the bullet points. Capital assets are, again, not provided by anyone outside your organization, by a customer or a contractor, for example, or a sub or a government. You have title to them. They're purchased with your own enterprise money. They're not for resale, and you'll have them over a period of years. At least that's the expectation. They have a useful life of 2 to 5 years or more, maybe 20, 30, 40, 50 years, and they cost a minimum of $5,000. These are kind of the generally accepted standards today, although the definitions will vary somewhat based on your organization, business, or enterprise. And again, they can be used on multiple contracts for multiple purposes over an extended period of time. So the idea is that these capital assets that you've bought and invested in will help you generate income and otherwise support your infrastructure. So it's okay that different companies in different industries have their own definitions for what does constitute a capital or a corporate asset. You may see that used interchangeably, corporate or capital. Corporate, by the way, another word meaning body, a Latin word. Aha, there I go again. So the important thing is that you keep and operate to those definitions for consistency. Okay, so the IRS has certain guidelines and rules, and you just can't change them based on whim. The accounting world also has standards, and these are all established and defined so that they allow you to run your business and calculate your profits and losses from one operating period to another, or 1 year to another. So you've got to define these rules, and then you've got to stick to them, and that serves as your baseline for depreciating capital assets. And this terminology is spelled out in your disclosure or your public disclosure statements. When you publish your financial statements, your profit and loss and balance sheets, you have to disclose to the public and to your stockholders how you derived your profits and your losses. And that includes depreciation of capital items. So they define how you come up with the values and balances that you publish, and they do provide a certain level of guidance to the casual investor or the outsider to your company. Okay. Capital assets may also be called other things like fixed assets. Corporate assets, I already mentioned, company-owned or durable goods assets. And we'll look at some examples of these here in a few minutes. So there are lots of other terms for capital assets. These are probably the most commonly used descriptions. However, depending on who is using any one of these specific terms, it may mean something unique to one person, but it may have a totally different meaning to another. For example, a durable good is an asset in that it was acquired for another asset, namely cash, but it may not fit the criteria that an accountant or a finance person has for it. It may be below the threshold for depreciation, but an economist, for example, would look at durable goods from a different perspective in that they're more concerned with the longevity of the asset. How many years will it produce for you, regardless of its cost? So, excuse me, the examples here, well, there's one example, a pipe wrench, okay? I mean, virtually, what, 1 or 2 moving parts in a pipe wrench? It's going to last a long, long time. So it does not meet the $5,000 threshold, for example, but as a durable good, it will last a very, very long time. So, a modern day example. Okay, in the world of economics, capital assets they're already produced durable goods, and they can be used for any non-financial assets. That is, they're not stocks and bonds, as I mentioned. They're used to produce goods or services. They're hardcore things. They're physical, tangible things that you can put your hands on. So here's an example that I think almost anyone can relate to when we talk about producer assets and consumer assets. So I kind of hinted at this. Everyone probably knows what this is. What do you guys think? It's a pizza oven. Okay, they're looking mystified here. It's a pizza oven. Okay, so anyone that works in a manufacturing environment, for example, you should be able to come up with many examples of equipment and large pieces of machinery, for example. And virtually every machine on an assembly line contributes to the direct production of a saleable product. So the products move down the line and out the door, but the assembly line assets stay fixed in place. So let's walk through an example here. This is a very simplified consumer version. So we have a pizza oven, okay? It's a capital asset. It's going to cost several $1,000s. It's considered in the category of durable goods, right? It's not going to wear out in a couple weeks or a couple months. In fact, it's going to last many years. Now, what does the pizza oven produce? Well, that's not a toughie, all right? We make pizzas. These are consumable goods, non-durable goods. So we've got capital in the durable category, and we have consumables in the non-durable category. So again, this is just a simplified illustration of the difference between hard assets, soft assets, durable, non-durable, capital or fixed or temporary. So there are two types of primary capital assets. And so another way to slice and dice this world of capital is to define them as frontline assets or background support assets. And as you can see by these definitions, both types of assets provide a necessary role. You think of it as a chicken and the egg thing. Is you can't have one without the other. You know, you can't run a railroad if you don't have railroad tracks. You can't produce things with your assembly lines if you don't have the infrastructure built around it. You've got a building, you've got heating and cooling, you've got utilities, all these background networks. These are part of your physical capital long-term infrastructure, and they're all there for one reason: to support the generation of products and services in your enterprise. So regardless of what business you're in, whether you're executing on government contracts, which I'm sure a vast majority of our audience today is involved in, think about the fact you have to have a facility to do that in. You have to have a background of support that is consisting of all these different things. And then you have to, perhaps you're building products, you have to have the machinery, the equipment, you have to test, you have to have all these different things to make to successfully execute on your contract and to deliver what the customer paid you to deliver. And we'll get into more detail here in a little bit. There's more examples that I want to show you. So now we're going to spend a little time here on the true cost of capital asset ownership. There's a life cycle involved. And again, some of you may recognize this chart that I've published a couple different times over the years. I'm going to explain the X and the Y, the vertical and the horizontal, and show you how it relates to the overall life cycle cost. So every item that you buy has what are called cost accumulators. So from the day you bring that asset into your facility, you start accumulating costs. So again, on the left side, you're going to see that's a $12,000 number there. You'll see from 0 to 12,000 going from bottom to top on the left. And from left to right, you'll see a timeline. It could be days, weeks, months, years. This is years. So again, let's take a few minutes here and look at this. You buy an asset at a particular cost. You've got receiving costs to add to it. You've got quality inspections. You've got tagging. You have to move it around, deliver it to the user perhaps, or put it in a warehouse somewhere. You've got to maintain and repair it over time. You've got to calibrate it perhaps. Obviously, you're going to depreciate it over a period of time. You're going to have audits, inventory control. You're going to have storage costs. You're going to pay for utilities to store it or run the machine. You want to protect it. You're going to have security costs. And all these different things you can see all the way down the line here. You've got taxes, you've got reporting costs, insurance, lots of things until you get to the end of life here. And you've got some kind of a disposal process that you have to go through. So again, we're looking here today at lots of different angles to this concept of and the subject of corporate and capital assets. There are some red lettered words here and some black lettered words. I had developed a life cycle cost model and used the red words for certain inputs to this model, and it helps us determine various costs along the way, and we can do all kinds of things with it. I don't want to get into the details of the tool today, but you can see here that throughout the life cycle of an asset, lots of things come into play here, and all these things point to your bottom line, profit or loss. So obviously, the fewer expenses that you can tag or attach to the particular asset, the better your profitability, right? So, okay. Why should you care about capital asset costs? When you know your cost of asset ownership, you can make many better decisions. For example, what type to buy? All right, so you've had some experience, you've been in the business a while, you like a particular vendor, you like a particular manufacturer, a particular style. So you have to take that into consideration. When you spend money on a capital asset, obviously, you hope to get a good return on it. And we'll get into that in a little bit as well. So you have to decide on what price you're going to pay for that asset. And can you buy them in quantity? Can you get a bulk deal, perhaps, if you're going to buy multiple units? When to buy more? So if you had a way to capture your life cycle costs, if you have an assembly line or a trucking fleet or any number of different facilities full of capital assets, you have to know when those assets are going to reach their end of life, and you should know how much money you've poured into a particular asset. Have you spent as much in repairs, for example, as it cost when you first bought the thing? You know, are you pouring sand down the proverbial rat hole? So it's important that you can track your assets, and you should have good records per asset, especially on the bigger ticket items. So how many to buy? Well, again, depending on the nature of your enterprise, if you're in an educational environment, for example, and you want to buy, a quantity of high-end microscopes, or you have to buy some new trucks, or you have to buy some new drill presses, or, you can imagine whatever business you're in, think about big ticket items that you have to buy and have to deal with. Where do you buy them from? Well, that ties in with what type to buy. All right, if you have a favorite brand, for example, or a favorite supplier, obviously you'll know where to buy them from. You want to tie all these things together so when the time comes, you know who has it, what's the best price, how are they going to get it to you, how many are you going to need. And I mentioned earlier when to stop repairing them. There comes a point in time on that cost chart that we looked at, the graph shows that there's a point where you have to say, okay, enough is enough. We cannot use this guy anymore because he's just costing us too much money to maintain. So that comes down to the final question: when to retire them from service. So if you can answer these other questions, then your chances of success increase. I hope everyone can see how this ties together here. You've got quantities, you've got prices, you've got sources, you've got all the details that go into acquiring or procuring a capital asset or corporate asset. Okay, let's look at something called value now. We looked at that chart that talked about cost and the life cycle cost. Now there's what I call 3 zones of an asset's life cycle. The first zone has to do with maximum productivity. And think of it this way: you buy a new car, right? You drive it off the lot. It's great. You love that new smell, right? The new car smell. And it's going to last for a while, but there comes a point when you don't have that new car smell anymore. Think of an asset, a production line asset, for example, where you've purchased it and it's producing widgets like crazy and you're making all kinds of profit. Well, a couple years down the road, it's been operating at maximum capacity, 100% perhaps, 95%, 98%. You can measure. A lot of people like to measure the production of their assets, especially in an assembly line environment. So, but the point in time does come when you start noticing that particular asset, that widget, is now slowing down a little bit. It's only producing at 80% or 85%. And again, if you're keeping tabs on your life cycle costs, there are ways that you can predict when that output of that widget is going to hit a point where you no longer can afford to keep it in production. So then you get into the zone of replacement tolerance. You can tolerate so much. You can take just so much before you say, okay, we have to do something with this blue widget. So these various colored lines here simply represent different kinds of value. Replacement value, that's really market driven. So depending on today's cost of a blue widget, it may be up, it may be down. The economic value, we're going to look at these definitions here in more detail in just a second. Utility value, okay, utility value is pretty important. That is the value that that widget gives your enterprise. In other words, you may be pouring money into it to keep it running, but that may allow you to produce what you need to produce. And we'll look at that in more detail here in a second. Depreciated value, obviously, this is a straight line model, and every year it's going to decrease a certain amount, the same amount each year. So there comes a point when you're not going to be able to write off or expense off any more portion of that original acquisition cost against your income. So this is, again, a high-level overview that if you think back to the cost scale and compare that to the value scale. All right, how are we doing on time here? Okay. You can see that there's a direct relationship here between the productivity and diminishing returns and replacement tolerance. So let's move on here and we'll get into more definition. Now, when we get to the end of the life cycle, you got some choices. All right, you can sell it, scrap it, donate it, replace it, upgrade it, retain it. You can repurpose it, or you can cannibalize it. We have an expert in the room here who does this on a regular basis. So again, you have to take a look at at what the item is. Is there a market for it? Is there a secondary market? What can you do with that item? For years, a lot of companies used to just take their old stuff and just throw it in the trash, and it would fill up a landfill. In the last several years, there's been quite a movement to recycle, obviously, and to repurpose. And a lot of companies are now engaging third-party organizations that will put these items out on the open market, on the secondary market, and they'll solicit bids from anybody basically around the world. And we've discovered that there is another source of revenue there. Instead of paying someone a couple $1,000s to haul off a huge machine, it may be that we can now make a deal with somebody across the state, and they'll come and pick it up, and they'll pay us a couple $1,000s for it. So when you consider the cost that you avoided and the income that you gained, you might have a swing of several $1,000s on one item. Okay, so just as a recap for these zones of productivity, again, this is when the asset's life cycle, when you see maximum productivity during the ZMP, I call it. The costs have been very minor since it was placed into service. And then it gets into this period of diminishing returns, and it starts to lose its capacity, but you're going to hang on to it because the costs are still tolerable. You're still going to put up with it, and you're not going to, in a lot of cases, you have this gut feeling that it's going to hang on, it's going to work for you, and you want to keep it around. There's a sentimental value sometimes related to some of these things. So these are, I want to explain how management may approach each one differently, again, based on things like available cash flow, for example, that would determine that what you would be able to do at any point in time. So let's say you get into the zone of replacement tolerance. It's EOL, end of life. Maybe you can limp along a little bit longer. Maybe you don't have the cash to go out and buy a new one. So you have your budget, your capital budget doesn't allow for purchasing a brand new one. So you're going to limp along with half that budget, and you're going to continue spending repair money to keep it on hand. So these are things to think about when you're managing your infrastructure, your background facilities, your assembly lines, your fleet of vehicles, or whatever it might be. All these factors come into play, not only from a financial perspective, but from an operational perspective. So, okay, let's talk briefly about those 5 types of corporate asset values that I mentioned. The acquisition value, for this discussion, it's the total collective efforts that lead up to the actual receipt of the item. So you go out and you say, okay, I really need this blue widget, and it's going to be great for my enterprise. So we're going to put some effort together, and we're going to go out and source this thing, and we're going to see if we can't bring it in-house. Now, the net book value is more of a calculated value, obviously. It's the remaining book value after you subtract the accumulated depreciation from its original purchase price. A lot of you accountants eat, sleep this stuff. Replacement value is the current market value or cost to buy another like item, to replace it, or to provide a backup. And you may not get the exact model, the exact style, the exact color, but if it provides you with the same form, fit, and function, then you're in. If you're happy with that, then go for it. Utility value, I mentioned that earlier. It's something, a lot of these are subjective, and they're harder to define, but it's utility value has to do with its usefulness to the company. How does it produce items for sale? How does it provide services? If there's any way you can measure input versus output, and we'll look at an illustration here about that in a minute, then that's what you should do in order to determine utility value. And finally, the economic value. This is a measured value that someone is willing to give up. So you're going to trade 2 red widgets for a blue widget because you think the blue one is going to give you overall longer term value. So again, you're trading something, you're giving up one item or service to get something else. And this is all, what we find in our supply and demand market driven economy these days. Capital assets, 235, come in all shapes and sizes. Okay. In most cases, some of you will relate to this more than others, but capital is replaced after a depreciation period, as we've mentioned. This happens to be a 72-year-old computer. It's called the ENIAC, 1946, 17,000 vacuum tubes, 30 tons. We have more computing power today in our hand than we had in this machine so many years ago. Comparing to today, here's a view of the NASA current day server room. A bazillion times more power. That's a highly technical term. I don't know how many bazillion it is, but I know it's a lot. So you can see that, technology is increasing at a phenomenal rate these days. And so what was good, 20 years ago, even 10 years ago, even 5 years ago, especially in the computer world, the advances are just phenomenal. They're hard to even track sometimes. Changes come out every 6 months now. Upgrades come out every, in months instead of years or instead of decades. So you can see that it's also possible that advances could make an obsolete form of capital practical again. Its utility value may be restored with, something new that you can add to an existing item. And the other thing here is that capital is distinct from land or non-renewable resources. They're not making any more land except for there are a few exceptions. We see where dredging. There are some nations that are building islands. They're putting airports on islands, so they're actually making more land, or drying it out, actually. So at any given time, the total physical capital that you have is referred to as capital stock. And again, not to be confused with you don't have with a portfolio of stocks and bonds, for example. So, in a fundamental sense, it's a thing that produces, and it performs economically useful work. So, again, going way back, I told you we'd talk about prehistoric hunting. I don't want to disappoint anyone. So, here's a partially depreciated capital asset going after a consumer good. Okay. So, again, beauty is in the eye of the beholder, right? So it's an input in the production function. Now, there are some exceptions. Homes and personal autos, for example, are not usually defined as capital, but they're durable goods, like the pipe wrench. They're not used in the production of saleable goods and services. In the world of commercial and commerce, in the supply and demand marketplace, we don't consider homes and personal autos. Those happen to be the output of other capital. So, why do we manage our assets so carefully? Well, we could talk for days on this subject. As we all know, there are lots of reasons that we have to manage our stuff. We've now branched out from local to state to national to international. And as the world continues to shrink, as communications continue to improve, as information continues to reach virtually everyone instantly, we have to work together. And these are some of the reasons. These are agencies, these are internal company requirements. And you might be thinking, yeah, this is why we have to build a $500 hammer, because of all the regulations and all the forms and all the things we have to go through. So I think most everyone is familiar with the International Standards Organization, the ISO 9000. You've heard of that. It's an international body that works together to try and bring common standards into play. SOX that was, for those of you that remember the Bernie Madoffs and the Enrons of the world, there was a lot of corruption back then. And so our government signed this Protection Act into law. It's been 16 years ago now. And estimates say that many tens of billions of dollars have been added to the cost of our products and services because of the SOX requirements. And of course, the FAR, DFARS, ICSA, our internal self-assessment, DCMA, DCAA. So all these different agencies, depending on what type of work you're doing for the customer, whether it's commercial or government, these have all been instituted for various reasons: for quality control, for safety, for all, cost control, cost management. There are things like accounting controls, like you'll see in the world of MACRS, for example, where you have to conform to the income tax code. The IRS is real sticky about the way we report our operations. And so it just makes good business sense. If you had your own business, and some of you may run your own businesses, everything that you have comes from somewhere. It came from cash. You had to buy it. You had to invest in it. And you have to sell, excuse me, X number of widgets to make profit to pay for that stuff. So who should care about capital assets? Contract managers. Can we meet the terms? And we could ask 100 questions for every one of these bullet points here, I'm sure. So if this manager is going to execute the terms of the contract successfully, does she or he have the existing resources to do that with? Property managers. Do we have the facility to shelter and protect our customers' assets and our own assets? Program managers. They work together in with the contract managers. Can we execute with the equipment that we have, for example? Quality managers. Is the infrastructure safe enough for employees? Can the equipment produce a quality product? Is the roof going to fall in the next time we have a 12-inch snowfall? That happens. Is water going to rise and come in the back door and ruin our inventory? Lab managers. Key people on the ground. They manage the production. They look at the, do their techs have the right kind of test equipment to build and test the products? Finance managers. Can we afford, from a cash flow perspective, from a profit and loss perspective, can we afford to add on to or upgrade our facility? Will maintenance and repair costs, are they going to eat us alive if we don't make some major repairs pretty soon? Warehouse and stockroom managers. Can we supply needed inventory for the production line using forklifts and delivery trucks? Can we do a JIT, just in time, where our facility across town needs something, and can we deliver it? Line supervisors. Can we meet the schedule given the current condition and types of tools on the assembly line? This is the where the rubber meets the road here. These folks have to meet their production quotas. They have to produce quality products, and they have to stay healthy doing it. So if you're the owner of the business or a stockholder in the business or a major chairman, a board member, you have to look at the overall profitability. Is it adequate enough to meet the demands? And we'll see here in a few minutes what happens to the cash that flows through a business and why you have to keep these kind of people happy. So basically, when you boil it all down, every employee in every business or whatever you're in, any organization, any entity, if you understand how all this ties together, you're going to have good job security. And so hopefully that gives you kind of a smattering of concerns that people have in an enterprise. So very quickly here, capital versus expense. Let's look at a high level. I mentioned earlier about what goes in and what comes out of an enterprise. Okay, business processes consist of only a couple of things. On the input side, you have people, you have assets for use, and you have assets for sale. That's really all you have when you boil it down, and you have expenses related to those items. You have to buy them, you have to bring them in, you have to maintain them. Okay, hopefully the output is going to be more in terms of sale dollars than the expenses coming in, right? So you're going to have only two things. You're only going to have a product or a service. And the result of all that effort is either a profit or a loss. This is about as simple as we can make it in terms of the overall business process and why capital is so important and why expense management is so important. So again, it doesn't matter what kind of activity you're doing, whether you're a big company, small company, you have certain basic inputs, certain basic outputs. And how you manage your business processes will determine whether you can stay in business and make some more products and make some more sales. So okay. A couple more small details here. I don't want to lose anybody on these formulas and stuff, but this is a real important one here, return on assets. It's a measurement of how profitable, how successful you are as a company. So you've got a total net income and you divide it by the number of assets, and that tells you it tells you how you do in relation to what you've got. And you can compare this to other competing companies in the same industry. A steel mill, for example, has hundreds of millions of dollars of investment in infrastructure. Imagine if you've ever been to a steel mill or seen movies or pictures of them, the investment versus a computer design house. So returns on assets, it gives you an indication of the capital intensity of the company. All right, now, very simple, another illustration I like to use. So who has the better return on assets? So time for some very basic math here. I don't want to scare anybody off if I haven't already. Check out these two illustrations, okay? We're going to walk through each one. For you shrimp lovers, now remember I talked about shrimp in the beginning. All right, here's Joe, number one. He's got a fleet of one shrimp boat, okay? He's out there every day, and he's cranking away, and he's got a boat that catches an average of 850 pounds of shrimp per day, okay? And for you shrimp lovers, I can confirm that the best shrimp comes right off the boat and into the pot. I've spent 10 years in Baton Rouge, and I can tell you it's some of the best food in the country. All right, Stan 1 and Stan 2 is competing against Joe. He's got two boats. Okay, he's out plying the same waters as Joe. So what he does is he catches a combined average of about 1,250 pounds of shrimp per day. So here's the big question. Who has a better return on his assets? Any suggestions here, folks? Yeah, that's pretty easy. Okay, Joe's investment is returning more than Stan's investment, obviously, on a per unit basis. And again, you can convert this to anything in terms of, again, assembly lines. You're producing a certain number of units, a certain number of widgets. So Joe's getting a better return on his investment because Stan is only getting 625 pounds of shrimp per day per boat. So that's not nearly what Joe's doing. So again, from a profitability standpoint, who knows? It depends on how much they sell their shrimp for and how they can pay off their investment. So factors of production. All right, we're coming down the home stretch here. Stay with me here. I know some of this is different than what you're used to, but again, this is a brief introduction to the world of capital management. The capital asset is part of a triumvirate, we might say, and this is a bigger picture that kind of sums it up. You have to have all of these things. These are the primary factors of production. You have to have land. All right, you can't have a facility without having land. So you buy a piece of land, you clear the land, but you have to have labor. Some of you know Rosie the Riveter from way back. Capital. All right, these are the primary factors of production. You start with the land, you add labor, you add investment to it, and you come up with the hard goods in order to produce, to create an assembly line that will produce capital items, or perhaps not capital items, perhaps just consumer items, small things. Okay. What is capital depreciation? How does it impact? We're running short on time here. I'm going to get out of the financial world here real quickly. We've had enough of that, I'm sure, for some of you. Why do we do what we do in terms of capitalization and writing off stuff? Okay, quick illustration here. We buy a $50,000 item in year one. By the end of the year, we're going to write off $10,000 in expense. It's generating income. Year two, we've written off another $10,000. So after 24 months, our net book value is $30,000 on that $50,000 item. We're still generating income. Think back to that cost curve where we have all these expenses pouring into it. Year three, year four, year five. Okay, so by the end of year five, on a straight line basis, we've written off $10,000 a year against our income that we generated. Hopefully that machine was paying its way, right? We hope it made enough widgets that we could sell on the market to give us enough profit to make our way. So what happens to this net income? And now I just picked an arbitrary $200 million here. So it could just as well be $20 million or $2 million. It doesn't really matter. That's the principle of the thing here. But this is how the capital free market economy works. And this is how people stay employed and business cycles continue in what we call a perpetuity, or almost perpetual motion, if you will, until some market forces or some other reason causes this cycle to not work anymore. So, all right, so we have all this net income. We pay out stock dividends. Why? Well, we want to keep the stockholders happy. We pay out bonuses to keep employees happy. We add to savings to support lean times because, as we all know, business is very cyclical. Markets go up and down. We pay down our debt to raise our stock price. We buy capital assets to generate more sales. Why? If anybody has young children, you know about the why thing, right? They keep asking why. Why this? Why that? All right. Well, the answer to this why is to create more income. And the cycle repeats itself. So, okay. This is kind of a summary of the 10, what I call the 10 life cycle stages of a capital asset, and it's very similar to the FAR outcome, 10 steps that you're all familiar with. The bullets under these are just a couple bullets of many, many bullets that cover each of these steps. And you can see we bring it in, we receive it, we accept it, we document it, we tag it, we configure it, we identify it, we utilize it, we monitor the deployment and the changes in it, we sustain it, we test, compare, repair, maintain it, calibrate it, we track it, we verify it, we count it, we do our inventories, we do our audits. So all these things come into play in this life cycle. And thinking again back to that cost curve, all these things contribute to that cost curve. So the more efficient we are in our organization, the more profitable we'll be, the more income we'll make, the more bonuses we get, the higher our wages, and on and on and on. So this is the world according to. This is an illustration that kind of ties it all together here, regardless of what you're doing. You've got some kind of activity that brings things in. You've got customer connectivity. You've got perhaps audits and compliance reporting. You've got to maintain the stuff that comes in. You've got a global network, perhaps. You have to communicate with them. You've got support. You've got a call center. You've got to keep your customers happy. You deal with third-party logistics, for example. You've got to ship your stuff around the world. You use legacy software interfaces. You've designed your own stuff internally to make your company work. And you finally have to dispose of your assets. So, okay. One of the nice things about living on the Space Coast here is we get to see real life launches in person. This was a recent one. You've all heard of a guy by the name of Elon Musk. Well, he sent some of his money into space. This was one of the most powerful launches we've ever experienced here. There was one more that was more than this, but we get to see this real time. We can step outside the door and watch these things go up. So talk about asset management and capital assets. This is the ultimate in our neighborhood here. So what goes up must come down. You talk about asset utilization at its finest. This is revolutionary in the business. I mean, for the first time, these last few launches, we've been able to not only launch a rocket into space, but we've been able to return the boosters to Earth instead of letting them burn up in the atmosphere or sink in the Atlantic Ocean somewhere. It's really cool to see. I got to see my first one land the other day, and it was amazing, just incredible experience. What did he send up in space? Well, he had too many cars, so he decided he'd launch one of his cars, and he put Starman in there. And this is an actual photograph from the rocket that was up in space. This was just a few weeks ago. So that's just one of the bennies for living on the Space Coast. So with that, ladies and gentlemen, we're just about out of time. Thank you very much for attending our webinar. I know hopefully you have a few questions. There's some contact information. I mentioned my book, where a lot of this information can be found. I go into a great more detail in that. But so with that, I'll let Jessica step in and see what we can do with a few more minutes.
Okay, sounds great. Thank you. Pulling up this question here. Okay, this is a little bit long, so bear with me for a sec.
Okay.
So with technology changing faster and faster, have you noticed companies' depreciation years being pulled in? For example, years ago, a computer may have been depreciated over 10 years or more. Now technology is replaced by newer versions all the time.
Okay, yes, it's a good question. Actually, not only with technology advances, but the costs have dropped so much that a lot of these computers aren't even depreciated anymore. They're just written off from an expense standpoint because they only last a couple of years, or they could last for many years. But the fact that, again, technology is increasing, you can expense them off, and it's not worth even depreciating them over a long period of time anymore. Hopefully that takes care of that question.
Thanks. There's a little bit more to it. I'm going to read a little bit more, and then let me know if it changes anything. So has there been an effort by companies to look at the fast-changing technology and compare to depreciation scales? We had several pieces of very expensive capital that were obsolete before the end of depreciation. Are companies depreciating capital on a faster rate due to the changes?
Yeah, that's the challenge. That's a good question. That's a good part of that question as well. There's kind of a lag, I think, with IRS guidelines and regulations in terms of the different types. There's a lot of categories of assets, and there's a lot of classes, and how you are to depreciate them over the life. You know, some 3 to 5, some 5 to 10, 20, and so forth. So I think there's a lag because of the increased pace of creativity and advancements that I'm not sure that a lot of companies are able to keep up with. So they run out of their equipment becomes obsolete, and they still had a couple more years to depreciate it. That is a challenge. That's a problem. I don't have enough information on that particular subject to really get into it in any detail, but I do know generally that is becoming more and more of a challenge because of these reasons that we've talked about.
Yeah, we have a comment in here that the tax book can be different than the internal book.
Absolutely. In fact, we have, I know companies that have had 3 or 4 different kinds of values. There's a tax value, there's a book value, there's a property tax value, there's an income tax, property tax. There are different kinds of book values, depending on who you're reporting to and what the regulations allow. That's exactly right.
Thank you. Now, I'm not sure if this person has a question. Janice, I am going to unmute you. Janice, do you have a question? Okay, I think that was an accidental hand raise, so I'm going to go ahead and unmute her back again here. I have a few of you that typed in asking for a copy of the presentation. I will send that to you. If anybody else would like a copy, just email me and I will respond with a copy of that presentation as well. And Bill, thank you very much for taking the time today to share this presentation with us. I do have that our hour is up, and I think it was an excellent presentation, and really appreciate everybody calling in today and providing some questions.
Thank you very much, Jessica. Yes, I enjoyed it.
Very good. Thank you so much. Have a great afternoon.
Thank you. You too.